Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. I teach intermediate accounting 1 and 2, both courses. And today's lecture is going to be about inventory and cost of goods sold. This is from intermediate 1, and it's for my accounting 3110 students at the University of North Texas, but it's publicly available on YouTube. Hopefully it might help some other students, that happenstance across this. I don't advertise it or anything. I am using the McGraw-Hill materials from the Spicer, Nelson, and Thomas book called Intermediate Accounting. It's a great textbook. I highly recommend it. And with that, I'm going to share my screen and get started. There we go. So inventory. We have, the inventory there's some complexity around it, and it's very important. In the last chapter, 2 chapters ago, we talked about revenue recognition. Revenue is the largest line item on the income statement. It's very important because are we selling anything as a company, and how much are we selling, and what's the dollar value of what we're selling? That is got to be super important, right? Well, guess what's also important? What's the cost of that stuff we're selling? What's the cost of those services we're providing? And so that gets into inventory, not for services. You don't really have much inventory if you're in the service business. You have maybe some. But so we're going to talk about, retail companies and manufacturing companies that do have inventory. And so when that inventory is sold, we reduce the inventory with what? A credit, and we record an expense called cost of goods sold. Guess what? That is normally the largest expense item on an income statement. In fact, a good important metric, which we'll look at later in this chapter, is called gross profit. And that's just revenues minus cost of goods sold. That tells us the gross profit. And there's a lot of information available in that number to see, hey, are we buying stuff as cheaply as we can and hopefully selling it for more than we bought it for, right? And so inventory and cost of goods sold is so important and so complex. There are, guess what, 2 chapters in the McGraw-Hill textbook. And we're going to start with measurement. How do we measure inventories that we purchase? How do we measure the inventories that we sold to be recorded in the cost of goods sold? And in the second chapter, we're going to have some more complex issues, some additional issues that we need to consider around inventories and cost of goods sold. So let's get started here on inventory measurements. So as I mentioned, inventory is an asset that is only for one thing: to resell, to sell in our normal operations of the business. And it's used to provide a benefit to our customers. And when we deliver that inventory to our customers and record revenues at that same time, matching principle, we match revenues and the expense, which is called cost of goods sold. We can think of inventory as 2 types. One would be merchandising inventory. That is a bit easier because we buy the inventory from a vendor. Now, we may pay for some freight to get it in the right place condition. We may still have some purchase discounts, return inventory, which we get into later. But basically, we're buying inventory to resell it. So think Gap, think Macy's, Nordstrom's, some of the large retailers. They're buying a lot of different products from vendors, and they're just reselling it. And compare and contrast that to manufacturing inventory, where we're making the inventory ourselves. And that gets a little bit more complicated because we've got a lot of cost involved in that. Number one, we've got raw materials. So we'll buy the basic raw materials that go into our product. If I think of the companies I work for, like Maytag, let's start with Maytag. There's a lot of steel that is used for the bodies of the washing machines and dryers and refrigerators and wall ovens, dishwashers, all of that. There's a lot of steel in that. And there are a lot of, as even in this example, a lot of computer chips in a lot of these now that are very expensive components for many of these products. At Lennox, heating and air conditioning, the compressor was a really big deal. That's kind of the guts of that product. We still had some steel, but then we had a lot of copper, raw materials copper. You walked into a Lennox factory, you would see rolls and rolls of very heavy, very expensive copper sitting back in the factory warehouse at the receiving dock. And all of that, those raw materials are going to be moved into the factory line. And now we're going to add some labor and some manufacturing over. There may be machines, big, gigantic machines, and in the case of Lennox or Maytag, that are going to stamp out that steel. They're going to process that copper in tubes and bend it and weld it and a lot of different things. And before it becomes a finished product, it's still inventory. And now we've added some processing costs to that inventory. So it's not a raw material anymore. Doesn't look like what it looked like when it came in the door. It's a big roll of steel or copper. It looks different now. And it's part of what we call work in process. And when we finally complete that product at the end of the last assembly line, there could be multiple assembly lines for these products, then we call it finished goods. It goes to the warehouse. It's ready to be sold. Now, again, a lot of cost. So manufacturing is more complex than the merchandising inventory because, the raw materials are easy. We buy that and we apply it. But here in the factory, we've got labor costs. Direct labor, our factory employees, associates that are providing, processing this inventory, stamping it, welding it, putting it all together on the assembly line. That's direct labor. And so those are not expenses right off the bat. We record their labor, their costs in the inventory because they're adding value to that inventory. We would not have inventory without that direct labor. In the same way, we have manufacturing overhead, which could be, number one item is depreciation for the big building and the big gigantic equipment that's doing this, and maybe the forklifts. There's a lot of different overhead costs that you could not make the inventory without these costs. So all these costs that are directly related to the production of inventory become inventory costs and get recorded in the cost of goods sold. In fact, we have a whole course, several whole courses on that at UNT, starting with 2020, which is management accounting. And then you get into 3270, cost accounting. It's another management accounting. I call it cost accounting, and even an advanced management accounting course. And it all relates to how do we allocate this cost to each unit that's being produced. Whole field of accounting is called management accounting. In fact, there's a CPA, certified public accountants, who work for the large audit firms and whatever. And there's also certified management accountants, CMAs. I happen to be both a CPA and a CMA. So it's a certification that you might want to consider if you're taking one of these accounting courses, considering the accounting career. I always had kind of a love for manufacturing because of the complexity involved. And even as a student, I liked all the math that went into this. And so I did, even though I was in public accounting with Deloitte to start out with, one of the large big four accounting firms, I did love manufacturing and always begged to be a manufacturing clients. They didn't always listen to me. But then eventually, when I left Deloitte, I went to work for Maytag and then later Lennox. My whole career is in manufacturing, and that's certainly something I enjoyed. Okay, that's enough about I love it, so I can't help myself but digress a little bit. I love manufacturing accounting. You're not going to have a lot of the exam questions, at least in my class, around the management accounting. We'll save that for the other courses. So let's get into, there are two types of inventory systems. And depending on the inventory system, the journal entries change a little bit. The first type is a perpetual inventory system, that every time we receive a product, the system automatically records inventory, and immediately. And every time we sell something, each unit is sold. You see a lot of companies, probably most companies use a perpetual inventory system. You see point of sale systems like at Finish Line, I think I, buy a lot of shoes, seems like, but when they sell one of those pairs of shoes, there's a point of sale system up on that register, and they're recording that transaction. That transaction gets recorded on the big Finish Line computer, and it deducts the inventory cost of those pairs of shoes and records the cost of goods sold. Every single one of these millions and millions of transactions at Finish Lines across the nation. So that's a perpetual inventory system. So we have to think a little bit differently about the accounting. And in this chapter, again, another nuance for intermediate versus principals. We have to think about the nuance here, knowing that our system is automatically recording these journal entries. So here's a company that starts with inventory of 120,000. They buy 600,000. They sell 820,000, and the cost of the inventory sold is 540. So automatically, the system indicates that the cost of inventory, it's already recorded. Remember, we'll get to it in a minute. We should have started maybe the second we didn't start there, but with the periodic system, which we remember from principles of accounting class, especially mine, spent a lot of time on this, beginning inventory plus purchases minus ending inventory equals cost of goods sold. We just go count the inventory in the end and we calculate that. This automatically does it for us. We started with 120, we added 600, 720, and then we subtract 540 minus 540, and we end up with ending inventory of 180. Every day in a perpetual inventory system, you could go look in the system and see how much inventory you have, what units, what types of products, how much do they cost. And that's really good for operational people who are tracking this to make sure they have sufficient inventory on hand to sell stuff, right? You don't want to run out, even though right now, this is 2022, a lot of companies are running out of stuff right now. So let's just look at, so the journal entries here, this is kind of a summarize of all the transactions recording, immediately things are recorded in the inventory and sales revenue and then the cost of goods sold pretty much automatically recorded for us. And so those entries are the simple entries. Yes, nearly all companies use this. Why? Because there's a lot of great systems that can handle this for you. And sometimes you use barcode scanning and RFID tags, and there's all kind of technology that tracks this inventory so that that what's sold and how much it's sold for. Okay, number two, what's a periodic inventory system? Well, we don't track every transaction. And this could happen in a lot of smaller companies where we just go out and count how much inventory is left. We track how much we purchased during the period, and we count what we have left, and therefore we know what our cost of goods sold, whatever's missing, right? And so it's cost of goods sold equals what we started with, beginning inventory in dollars, plus how much we bought and purchases, because every time something comes in, we are going to record credit to cash or accounts payable and debit to purchases, right? And then we count what's left at the end, ending inventory. So this is what we call beginning inventory plus purchases that was available to be sold. Here's how much we have left minus what's left. So that tells us what's missing. What's missing becomes cost of goods sold. Hopefully it wasn't stolen. Hopefully it was all sold. So here's an example. Again, more like you would have seen. Again, this is the same example as before. Started with 120,000, purchased 600,000, 720. Here were ourselves, and then we went. So we kind of go with backwards here. We know what's left. We don't now have the cost of what we sold. We're not tracking that in the periodic system, but we know what's left. So during the period, here's the journal entries that we do here. Well, here, let's just look at the math first. So 120 plus the 600,000 purchases. Here's what I referred to. That's the cost available for sale. Available for sale equals, again, just going to mention this again because it's important for you to know. Beginning inventory plus purchases equals available for sale. Then we go count what's out there, 180,000. So what we had in total for the whole month was 720. There's only 180 left out there. We counted it and dollarized it. And so here's how much was missing. That was our cost of goods sold. So the journal entry would be a little more complicated than what we saw in the periodic system. We're going to go record that cost of goods sold. We're going to, there would be another way of doing this. I won't get into it, but you could just do a $60,000 debit to inventory because inventory increased from 120 to 180. They're going to subtract out what we started with. Maybe this is easier. You won't make an error, and debit the ending inventory. So you can see we started with 120 in the books, and then minus 120, we're at 0. And then plus 180, we get to what? The amount we counted. Where did this number come from? We went out and did a physical inventory and counted all of our units and times the cost of those units, 180,000. And during the year, during the period, whatever this was, accounting period, month, quarter, whatever, we did debit purchases. Remember, let's go back to that previous entry. We were debiting purchases, 600,000 during the period. Now that's got to go away. Purchases is not a line item on the income statement or the balance sheet. So the purchases started with $600,000 debit in this adjusting entry, minus a $600,000 credit, it's 0. So what are we left with on the books? We're left with a $60,000 increase in inventory. So it goes from 120 to 180. That goes to the balance sheet, 180. And the 540 goes to the income statement. The largest line item on the income statement, the cost of goods sold. So let's compare the two systems. Every time something is sold, the inventory is decreased, if you will, reduced, and the cost of goods sold is recorded. But in a periodic system, we wait till the end of the period, count the inventory, and we take and allocate all the costs that are available for sale between two items: ending inventory, which we counted, and cost of goods sold. So really, you could do an accurate financial statement without doing a physical count of the inventory in a perpetual system. Now, I'll just note here one, and I wouldn't say it's a disagreement because they would, I'm sure the textbook would acknowledge this too. At the end of the year, even if you're in a perpetual system, for your internal controls, back to our Sarbanes-Oxley and internal controls, we would want to do a physical count for two reasons. Just to confirm that our system is operating correctly, recording all these journal entries correctly, and confirm that maybe something was installed or there was a fraud. So we will actually, at the end of at least once a year, go out and physically count the inventory, even in a perpetual inventory system. So in all the companies I work for, we use perpetual inventory systems, and we did physical counts at the end of the year. And sometimes there were problems. I remember one business had $3 to $5 million adjustment, missing inventory at the end of the year. It was not good. And there were some problems with the way the perpetual system was calculating that. And so it took a lot of work to figure out what was going wrong. And we fixed it. And so at least our financial statements were correct because we adjusted with the physical count. Now, in the periodic system, you got to take a physical count every period. And so if you want to do monthly financial statements, you got to go count every single month, every single quarter. That would be hard. Here, you might do a physical count once a year. You might have cycle counters who check it. You never do a physical count. There'll be some kind of controls here. Here, the physical count is part of your accounting system. It is your accounting system. It's how you record cost of goods sold. So this becomes, as I said, this makes the preparation of interim financial statements more costly. Interim means within the year, monthly or quarterly, whichever they do. Perpetual systems are costly. Things like SAP and many of them are very expensive systems. You're talking about in the tens of millions of dollars to implement. These are cheap. All you just need is counters. You could use your factory employees to go out and count things, right? And all of that. Now this allows complete tracking of the inventory every day, and that's important. That is, help you manage inventory. You really cannot track your daily inventory And it's a little, it's everything is fuzzy in a periodic inventory system. That's why nobody uses it. Okay, what units, we're switching gears here, what units are included in physical inventory? Goods that are in transit, goods that we have in anticipation, in possession of by in our warehouses or wherever our factories, goods on consignment. And remember, anticipated sales returns from the last chapter, that we debit inventory estimated returns, knowing that some products we've sold will be returned. Let's look at each of these. Goods in transits. This is when the goods are on their way to, they're coming to us from our vendor. They're in transit. They're on a truck. They're on a train. They're on a boat. An airplane. So now, how do we account for goods in transit? It depends on who owns them in transit. If we own it while it's being transitioned to us, it's got to be our inventory. If the vendor owns it, it's got to be in their inventory. How do we know? It's in the terms. And that's what we call FOB. There's two legal terms, FOB shipping point and FOB destination. I'm not good to this whole example here, but if the goods are shipped FOB shipping point, that means title passes when it leaves the warehouse. And so who owns it? The buyer owns it. And if we're the buyer, which is for inventory, we're going to be the buyer of that. So we need to record that as inventory, debit inventory, credits, accounts payable. So we need to know at the end of the year how much goods have been shipped to us that are in transit, but not in our warehouse by the vendor. That's a little bit of a challenge to call all your vendors and try to get that information. It would be easier if the goods are shipped FOB destination, means title passes when we receive the inventory. So this becomes a challenge. Goods in transit be an easy thing to miss on inventory. Now there's not an income component to it, because it would all be balance sheet, debit inventory, credit, accounts payable. So from one side, it may not be material, but then again, it could be. So as an accountant, as an auditor, you'll be looking for these things. Another area is what we call goods on consignment. And this is where we, the transferor, or we'll call it the consignor, let's say that's our company, and we're going to let someone display our products. I can't think of a good example because I didn't do much. Did some of this with our displays out, and I mentioned that in one of my other lectures. We may, as a manufacturer, especially at Maytag, we ship washing machines, dryers. We display products in Home Depots and Lowe's and Best Buy, and we consider that consignment, that we own those displays that were out there, even though it's sitting in their warehouse. So if we own it, even though it's been shipped to Lowe's for display, we still own it. Therefore, it's our inventory. So goods on consignment, they must be recorded in our inventory, even though they're not in our possession. Why? Because the legal title has not passed. So therefore, we only sell this inventory. We only record a revenue and a reduction in inventory and cost of goods sold when the person that we've consigned it to, they sell it. Now, they may return it, but if they sell it. What we did a lot of times is have we'd ask Lowe's, Home Depot, hey, we've got a new model out. We want you to get rid of all those displays out there. Go sell them cheap, put them on a discount, get rid of them. And when we knew they were sold, then we would reduce our consignment inventory and credit revenues, and we'd ship them some more stuff on consignment. And so just keep in mind, when consigned inventory is still inventory. And so that's one of those things there. And so sales returns, we may receive inventory back. And so we will have, remember from before in our sales returns, I believe it's in the revenue chapter, or it could have been in the accounts receivable chapter, we are going to record a refund liability for estimated future returns. We also debit estimated future inventory, and that's going to be returned. So it's an estimate. And so that's part of return. All right. Again, those are the things that are imminent inventory. Let's see if we cover all those. Yes. Sorry, we did. Items in our possession, in transit, goods on consignment, anticipated, not actual sales returns, anticipated sales returns. All right. So what can affect, what cost should be included in inventory? And a lot of times the word we use in business, it's not really in this chapter, is the word capitalize. Which cost can be capitalized? What's the opposite of capitalized? Expensed. So some costs are just expense right to the income statement. But some costs we're going to capture in as an inventory cost. It will not become expense until we sell that inventory and record cost of goods sold. So obviously a lot of operational management, they like capitalized costs because they don't like expenses hitting their budget or their financial statements. And expenses reduce net income, reduce bonuses, right? So people like capitalized costs. And so as an auditor and as an accountant, as myself as a former corporate controller, we had to make sure we're only capitalizing the appropriate costs that can be capitalized. So what can be capitalized? Oh my goodness. My mouse is way too sensitive there when I touch that. So, so this is the primary words here that come right almost straight to GAAP. Any cost or expenditure that brings the inventory to its desired condition and its location for sale or for use in the manufacturing process can be classified as an inventory cost. So certainly, if we have to pay for the freight to have the product shipped from our vendor to our manufacturing warehouse, or from our vendor to our retail store, that could be a capitalized cost. That can be included in inventory. A lot of times the word we use is freight in. Freight in is capitalized as inventory. Now we'll see it in the later slide, but freight out is freight that we may incur, like free shipping to our customers. Now we've incurred the cost for freight out. That's part of the selling process, not part of the inventory process. So freight out is a cost of goods sold immediately. Freight in is an inventory cost. I hope that makes difference. I think we'll see a slide and I'll repeat this all over again because it's so important. So definitely net purchase equal total purchases plus freight and other costs. And in minus, we might return some of this, just like we saw our customers return stuff for us. And there may be some discounts that we'll see. And there will be a subtraction from inventory costs. So I want to get into, here, shipping costs on outgoing goods, they're not included in the cost of inventory, only the freight in. So freight in is immediately recorded inventory count for in a perpetual system, but in a periodic system, we might have a separate count called freight in or transportation in. And it'll be added to purchases when we're doing our available for sale calculation. Okay, just like in the last chapter, we sell stuff, but we give our customers a right of return. We also may have a right of return with our vendor. Maybe the thing got dinged up in transit, and we have guys at the receiving docks, they're checking that stuff, and they say, hey, we're returning this to you. And so that will be a reduction from purchases, right? So we will have a subtraction, both in inventory and in accounts payable. Hey, we don't owe you for this anymore. We're returning it to you for whatever reason. And remember for my previous lecture, and I believe this was in the accounts receivable lecture, that we may have purchase discounts that are very similar to sales discounts, which I call all these cash discounts. So like we did for our customers, where we gave them some special terms, 210 net 30, gave them, you could pay us 2% less if you pay us in 10 days. Otherwise, you get us pay us the full amount in 30, 210 net 30. By the way, it could be 5, 15, in 60, that would be 5% discount in 10 days, net 60. So there's different ways you could go about here. A 210 net 30 is a very common one. So we're going to get that too. And so we can reduce the cost of the inventory by that 2% if we take it. Just like sales returns in our previous chapter, we can do the gross method or the net method. Under the gross method, we only take that purchase discount when we take it. Under the net method, we assume we're going to take them all. And a lot of times we do want to take them all because we want to reduce the cost of our inventory. And again, I'm not going to spend a lot of time on this because we saw this in the last chapter. And so here in the gross method, on October 14th, when you took the 2%, then you record it as a credit to inventory. All right. Now we're getting to some of the meat of this chapter and some of the difficulty that students face with inventory. And I think this is a good slide here that looks at it. So here's the unit, and we're going to stay with this same example throughout the next few slides. So really be focused on it. If you're reading the textbook and you see this, probably the same example in the textbook, you want to be able to follow these through, and where you reach a point where you're a little confused, go back. This is why a physical textbook to me is better in accounting than the electronic book, so you can flip pages back and forth and follow the example. So, and I'm not going to do that here unless my mouse gets too sensitive. We switch back by accident. I'm not going to go back and forth here. So try to hang with me on this. So here, in this, the Browning Company, they started with 4,000 units, and this looks like a whole year during 2021. On January 17th, they bought another 1,000. March 22nd, they bought 3,000. October 15th, they bought 3,000. So they had goods available for sale of 11,000, and they sold 6,500 of these. So how much is left over? 4,500 units. Now here's the challenge. Those units cost different amounts every time we bought them. Think about Linux. We bought copper every single day, maybe even on Saturdays too, I don't know. Well, copper prices change for us every single day. And so you could have multiple kind of costs here. And then, think about copper, think about shoes, think about oranges at Kroger. You can't store them based on the various costs. So when you look at these $6,500, 6,500 you sold, I guarantee you don't know which ones you sold. No operational person is ever going to, and they're all bigger than me, by the way, they're never going to allow me to say, hey, you keep the 551s in this bucket on this bench or in this rack in the warehouse. The $6 ones, put them over here, and the $7 ones put here and $7. No, they would kick me out of the warehouse probably by the feet and throw me the heck out of Dodge if I tried to make them do something like that. So here's the reality. We don't know which of these 11,000 units were sold. No one's tracking that, and they all have different costs. So that's a problem. And so we know that at the end, we like here, we had 11,000 units for sale, available for sale, and we had 4,500 on hand at the end and 6,500. So we know in units. Units is easy. A unit is a unit is a unit, but it's the cost that's the problem. What price? We had 4,550. We bought 7,000 at various prices. Okay, what's the dollar amount? Because we have to put dollar amounts on one of the most important line items on the income statement, the cost of goods sold. We keep put units there, we've got to have a dollar amount. And we got to record gross profit, the dollar amount for revenues minus the dollar amount for cost of goods sold. And so we've got a challenge there. Now, before we get into the three cost flow methodologies, again, same ones you saw in Principles of Accounting, it could be that you can specifically identify every single unit sold. Now that's going to be by companies selling unique, very expensive products with low sales volume, with unique identifiers. And they had the example that I would have used, automobiles. When you go to an automobile dealer, they know, they might not tell you, but they know their actual cost of every single vehicle from their entire lot, both the used ones and the new ones. They have a system that records every serial number and the cost of that serial number. And so when they sell that automobile with that serial number, they can debit cost of goods sold because they know exactly how much that unit cost them. And so that could be with maybe very expensive jewelry, artwork that's very unique, right? And so everyone has a specific cost. Well, that is more, I would say, the rare circumstance. Most companies have lots of inventory. Think Kroger, oranges and apples and cereal boxes, everything that's flowing in through a Kroger and out of a Kroger. And so we got to have, we're just going to have to, we don't know. Here's the problem. We don't know in accounting which dollars sold. So we're going to make some assumptions. Once we make an assumption, the cause of the, go back to principles that we talked about in the accounting concepts and framework, we have to be consistent. We can't change each year based on which method gives us more profits. So once you pick a method, you got to stay with it. In fact, if you change methods as a public company, especially if you change from LIFO back to FIFO, you have to get a letter from your auditor saying that was a preferred method of accounting, and you have to, file that with you have to let the Securities and Exchange Commission know, and you have to disclose in your footnotes why you changed. And so that's, again, very rare to see people change. And so we'll look at all these methods, and I think you've seen these before. The average cost, we just take the average of everything we bought and what we started with, and we recorded out the cost of goods sold inventory on the average cost. First in, first out. And just like what it says, we're going to assume the first ones we bought are the first ones we sold. Now, is that what really happened? Well, probably not. Depends on how you stored them, Maybe it was really, you stacked them up and you took the ones you put in there last, you take them out. That might happen. We don't care what actually happened. We're just going to assume for everything that the first one's in or the first one sold. And that's called FIFO. We use terms that reflect exactly what happened. We don't try to get fancy with you in accounting. We're not like those finance guys or biologists or rocket scientists. We keep it simple, and that's good for guys like me. I like it to be simple. I'm not a rocket scientist, nor do I really want to be. And then here's another simple one, LIFO. In this one, the last in, we assume they're the first one sold. Is that what happened? Yeah, this is actually more, probably not. But we assume the last ones acquired are sold first. And so the accounting changes on this. And so average cost is calculated only, okay, this is now the periodic system, okay? So the periodic system and the perpetual handle these transactions differently. And you're gonna need to know that when you come across an exam question or a problem on the exam. And so here's the periodic system. So again, we started with $22,000 of inventory. We purchased 7,000 at various prices. We had goods available for sale of 11,000, and they cost us 71,500. Well, we stop right there and see what's the average cost of all those units. That's easy math. 71,500 divided by 11,000 equals $6.50. So all those 11,000 units on average cost us $6.50. Therefore, boom, I'm going to take my ending inventory, 4,500 at 650, and that's 29,250. Subtract that from 71,500, and I've got cost of goods sold of 42,250. By the way, if you divided the 42,250 by the 6,500, 650. So it's a perfectly I love this method. You know, I've never seen a company use it. All of my companies use LIFO, and we're going to get into the end of the chapter to find out how we did that. Now, under the perpetual inventory, it's a little harder. Every time we buy something, we're going to take a new average before we sell the next one. Now, if we would have to have like 1,000 accountants to track every transaction in every Finish Line store, but guess what? They have systems that do that, automatically calculate. So here we had 4,000 at 550, and then we bought 2,000 more at, we sold 2,000 of these 4,000, and so we started with 4,000, we sold 2,000 at the 550. Now we got 2,000 left at 550. Now we're going to go buy 1,000 at $6. So that's $6,000 worth. And on January 17th, we get these new ones in, we go calculate a new average. We don't wait till the end of the year. Every time we buy something, a new average is calculated. And then we bought some more, 3,000 more at $7. And we calculated a new average. See how the average started at 550, 5,667, 633, and then we sold some. So wherever we sell some, we take the average at that point in time of our most recent purchases. And then we buy 3,000 more. You know, at this point, our balance in inventory is 4,500. We buy 3,000 more, and we have a new average. And so you can see how that works. So every time we buy it, every time we buy something, we calculate a new average, and that's the average we sell in the next sales transaction. So it's a continuous rolling throughout the year. Now, here's we're moving to the second method. We just did the average cost method. Now we're going to do FIFO, first in, first out. Easy again in the periodic method, because we can know these first ones are going to be sold first. And so what's in cost of goods sold? We sold 6,500. So let's start. We start and we work down. These 4,000, they go over here. 4,000 at 550. And then we sold another 1,000, $6. And we sold another 1,500. And that takes us, that's the 6,500 we sold, the very first ones that we bought. First in, first out. Well, the last ones are still remaining in, first out. So the 4,500 come over here. By the way, if we'd have sold 7,000, we would have pulled 500 out of this $7 bucket and put it up here. And the other 1,000 would have gone down here. And I think you've seen this before from your introductory account. Now, here in average in the perpetual system, again, every single one, what we did here in this, we do after every transaction, So every time we sell stuff, we sold. So these 2,000 were sold from that 4,000. These 1,500 were sold. 500 more from that 550, and 1,000 from the $6. So you're just continually pulling the first ones in the perpetual method. All right. Now, I see the slide has an error in it. It says FIFO. That's why I was confused. I must have been on the wrong slide. That should say LIFO, last in, first out, not FIFO. So this is just an error. So in the LIFO calculation, again, the last ones we bought, so we sold 6,500. And look at this is working from the bottom up. So these 3,000, they're the very, very last ones we bought at 750. Okay, they're in our cost of goods sold. We're trying to get to 6,500. So I need another 3,000 at $7. 3,000 at $7. And then here's where we split. The January 17th, remember we bought 1,000 at $6. Well, 500 of them are going to be assumed, not really, but assumed by accountants, sold. And then 500 are going to assume to remain in that ending inventory. So we look at what we sold. It's all the most recent purchases. What's remaining? It's kind of hard to think about because it doesn't seem like most inventory flows, but those 4,000 we had at the beginning of the year, they're still there. Now, in reality, if I was an operational manager, I said, man, get rid of those, sell the earlier ones first. I'm worried they're going to go bad. We are totally divorced in this assumption from how the operation is moving the goods. It's just an assumption, and we stick to that assumption no matter what. Why do we do that? Because we don't know. We can't figure it out. So we make average cost, FIFO or LIFO assumption, and we do the math based on that. Now I'll show you why a lot of companies use LIFO later in this chapter. Now here's the same LIFO in the periodic. So we had 4,000 and 2,000. So look at these 7,000 that were 1,500 that were sold here. We're going to pick up from the most recent purchases. These 3,000 here were the most recent purchase. So with this 1,500 goes in at $7. And then we sold another 3,000. Well, we pull that out from the most recent. So you're going to get a different answer, in a periodic versus the perpetual, because we're doing every time we sell something, we're redoing what we did in the periodic only at the end of the year. So it becomes a little harder, for accounting students especially. And it would be pretty hard for your system to track it like this. And at the end of this chapter, we're going to show you the shortcuts that most companies use when they do LIFO. So this is a very important slide because let's compare the three methods. Guess what? We got different answers. And let's look at the ending inventory. The ending inventory under FIFO is much higher than LIFO, and the average is in between, as you kind of expect for the average. Now, why is the ending inventory under FIFO higher? Well, that's because, the first ones we had, they were cheaper and they're gone. So what we're left is with the more expensive inventory that we bought later. And so LIFO still has those 4,000 units in it that only cost us $550. So it's cheaper inventory. Now, if the inventory is higher, then the cost of goods sold will be lower. Remember, available for sale minus ending inventory equals cost of goods sold. And so, we're either allocating available for sale between either ending inventory or cost of goods sold. So if we allocate a smaller number to the a larger number to the ending inventory, 33 versus 25, then we end up with a smaller number in the cost of goods sold, 38.5 versus 46,500. So in rising prices, and generally we think in terms of the economy, we generally see 2 to 3% CPI, price increases every year. Now we're seeing 7 to 8. So now we're seeing really significant rising prices, which we haven't seen since the 70s, really 70s and maybe early 80s. And so in rising prices, FIFO is going to give you a lower cost of goods sold. Why? Because the more expensive goods are still sitting in inventory. They were not expensed in cost of goods sold. Now, if cost of goods sold is lower, let's go back to the income statement. Revenues minus cost of goods sold equals gross profit. If cost of goods sold is lower, our gross profit's going to be higher because none of this affects our revenue, what we sold it for. That doesn't change. So therefore, if our cost of goods sold, our expense is lower, our profit is going to be higher. So profits in rising prices, net income will be higher under FIFO than LIFO. And that's all this is saying here. During rising costs, FIFO results in a lower cost of goods sold, and higher ending inventory. Now, if we have declining costs, the opposite would happen. FIFO would result in a higher cost of goods sold and a lower inventory. But generally speaking, we're in a rising price environment. So FIFO generally results in lower net income. Let's see if I get there. And we're gonna get there in a minute, but I'm gonna go ahead and steal that thunder because that's really important here. Why do companies use LIFO? And they end up with lower net income. Why would they ever do that? Everybody wants higher net income. Well, there's one reason: income taxes. If I have lower net income, I pay less tax to the government. And so that is the whole benefit of LIFO. It's about income taxes. Don't let anybody tell you differently. FIFO, LIFO, they're average, but all permissible under GAAP. You could have separate inventory. By the way, LIFO is totally a United States convention because the IRS allows LIFO. No other countries' governments allow LIFO for tax purposes. So you never see LIFO anywhere else in the world. So if you're a multi-global company like I was, all the foreign entities, they're on a FIFO basis. And so in the US, we were on the LIFO. So yeah, I could not force all those foreign entities to be on LIFO. Didn't need to be because there's no tax benefit. So there, you back to taxes. Now you have to disclose this. And you see here, 47% of the companies use FIFO, but 24% use LIFO, which is kind of interesting because LIFO is so much harder. It takes a lot more effort. Okay, here is the main issue. Most companies use LIFO because of lower taxes that get paid. And we have this. Here's the one thing I don't want to just go through every point on these slides because it'll drive you nuts. This is an important thing here. And this is what's called the LIFO conformity rule. And if you're in my class, you'll get a multiple choice on this. And I assume in any of your classes, because it's something that you must know. And if you're taking a CPA exam, that's going to be a question there. The IRS knows that companies want to report lower taxable income, and the IRS knows they do this for LIFO. Therefore, they have some pressure in the system. Yeah, you can use LIFO for taxes, but you only can do it if you're using it for your financial reporting. And so that's called the LIFO conformity rule. If a company uses LIFO to measure taxable income, it must use LIFO for external financial reporting. And so there you go. I mean, the companies would rather do LIFO for tax and FIFO for financial report. That's what they want to do. So they can report in rising prices, higher net income externally, but lower net income for taxes. So that's the pressure in the system to keep people from just going straight up to LIFO all the time for tax purposes. So you must be doing LIFO. If you use LIFO for tax, you must also use it for financial reporting. Again, that's called the LIFO conformity rule. Okay, now this is how, by the way, most companies do LIFO accounting. They keep everything under FIFO or average cost for their internal records. All the companies I work for were on LIFO, but the day-to-day operational systems were on FIFO. They said, well, how did you get to LIFO? Well, we're going to show you here. You know, there's some, if you will, shortcuts that a few accountants in the back room can calculate what the LIFO should be. And then we have this thing called LIFO reserves. And so it's a contra account because generally speaking, because of rising prices, the LIFO balance of inventory is lower than the FIFO balance. If you're keeping all your records here at FIFO, you're going to need a credit in what we call a contra asset inventory account. It's called a LIFO reserve account that adjusts your inventory balance to LIFO. Why would you want to keep your internal records something different than LIFO? Oh my God, look at all companies use Perpetual. Look at how hard that Perpetual calculation was just in the slide in the textbook and trying to track every purchase and get the last in. It would take some crazy algorithms for some of these systems to go find the last one purchase to record as cost of goods sold. So it's much better, easier for the systems to keep it on FIFO. And, there could be some contracts that are based on net income under FIFO. I've never experienced those. But here's a really important one, I think, is that our FIFO accounting, that's how we determine pricing decisions, what we track to the system. And I guess some companies, we saw that over 20% of the companies use the average cost method. Never used that myself. So the LIFO reserve entry would be, let's say the company had 475,000 in the LIFO reserve account. By the way, that's a credit, meaning that the balance in their LIFO was $475,000 lower than what it was on FIFO. So if you had 10 million of inventory, you would have this 475 offset, and then you'd have 9,525,000 in inventory on the balance sheet. So it's just an offset to inventory that we just keep in this special place called the LIFO reserve. And what happens at the end of the year, we're going to go calculate, and we have ways of doing it. I'm going to show you in a minute. Well, the LIFO inventory should be $535,000 less. And we usually do this once a year. So if we know, hey, the difference between FIFO and LIFO is 535, but we only have 475 in the LIFO reserve account, well, we got to go credit the LIFO reserve. And so by how much? 535 minus 475, 60,000. And then what's the offset? Cost of goods sold. And so we'll do this big monster calculation called the LIFO calculation. It was a crazy big spreadsheet at Linux. I spent a lot of time around the LIFO account, and we got to the final adjustment. It always would surprise people. And I remember I remember a couple of just tough conference calls after we just spent so much time analyzing this LIFO calculation. I remember one time at 5 p.m. on a Saturday, we called the CFO to say, here's the number. And it is right. We scrubbed this every which way. And I remember the CFO was pretty quiet. He wasn't happy because it was, it was more like this kind of adjustment here, where we're going to be debiting cost of goods sold and adjusting the LIFO reserve. And so it could go the other way. So the LIFO reserve could be less than it was last year. Then you'd have a credit to cost of goods sold, or a higher gross profit because of that. But in many cases, you got to do this LIFO reserve adjustment that reduces. This slide is just basically terminology I want you to know. A LIFO liquidation. A LIFO liquidation is, it's always the last purchases that get expensed first. But sometimes maybe we didn't buy that much this year, and so we started with X amount of LIFO inventory, and we sold more than we purchased. And so you got to think about this for a second. If we sold more in the year than what we purchased during the year, then some of what we sold had on hand at the beginning of the year from last year. And those are going to be at older costs, maybe lower costs. It's called a LIFO liquidation. You may reach back several years and have costs that were 5, 6 years old. And so those are really low costs. And so you generate more profit a lot of times when you have a LIFO liquidation. In fact, the Securities and Exchange Commission requires that you disclose any kind of abnormal profits that you had based on the LIFO liquidation. So that was another calculation we had to do at the end of the year. All right. We've got a couple of easy things before we get to the hard stuff. So, I have talked about the gross profit, the gross margin ratio so many times. And so that's just gross profit dollars divided by revenues or net sales. That's the gross profit. Usually we try to do it in the percent terms. So, that's the gross profit ratio, gross profit. So this would be in percent terms. And so if you're at an 80% margin, man, you were like, that's like Microsoft, I think, had 80-90% margins because their software didn't cost much and they're selling it. Used to sell Windows for like $150. It cost them like $5. Think about the margins here. Think about the opposite side, like Kroger, because oranges are very competitive. And I like to use oranges. I love oranges or apples, whichever. They only have about a 5 or 10% gross margin because they can't really price it higher than Walmart or Tom Thumb or Safeway, another grocery store, because they're all an orange is an orange is an orange, pretty much. And so kind of a very low gross profit percent. So the companies I work for, the gross profit percent was about 35 to 45%, which was, it was pretty good, and so if one company has a higher gross profit margin than another company, means they probably have some pricing power, maybe because their brand, they can sell things at a slightly higher price. And so or they're buying it cheaper too. That could be too. So you generally want to invest in companies at a higher gross profit margin because there's something going on there. That's a good news. So this is a measure I really like to look at. Another ratio, this is very much like the accounts receivable turnover ratio. It's just taking cost of goods sold divided by the average inventory. So this just tells us how many times our inventory is turning a year. So if it's, again, you can do the same measurement like we did with days sales outstanding on accounts receivable. Is if your inventory is turning 6 times a year, and let's assume there's 360 days in a year, I know there's 5 more, then you got about 60 days worth of inventory. If your inventory is only turning 2 times a year, so this calculation becomes a 2.0, means you got 180 days worth of inventory. Oh, I got questions. If you're only turning the inventory a couple times a year, boy, what's going on? Number one, is that inventory good inventory? Maybe it's crappy inventory that you cannot sell. That kind of scares me as an investor, or maybe someone who wants to work there. So you're looking for a higher turnover ratio, meaning that the company is effectively buying inventory that can quickly sell versus buying inventory that sits around in a warehouse for a long time. Okay, now we get into a bit of a tougher area, a very important to know, especially if you end up in a company that's doing LIFO. And so these are the methods of simplifying LIFO. And what I would say, this is a way not to track every transaction during the year, not to try to do all the things we just saw in those slides, but we do some simplified methods to calculate the LIFO reserve. In other words, our books run on FIFO all year or an average cost. And that's how my companies operate. And there's 2 kind of methods to use: LIFO inventory pools or dollar value LIFO method, even easier. And the companies I work for, we use the dollar value LIFO method. And by the way, there was, I know for Linux, there's probably 5 people who understood it in the entire corporation, because everybody and all the accountants are operating on FIFO. There's about 5 or 6 of us who had to sit back and do this calculation. Now, I was fortunate as corporate control, I was mostly reviewing it. Even then, it was hard, but you had to get into the weeds there and look at it. And so grouping into pools, and I think it's harder to look at the words here than to see an example, but you look at the pools and you convert each pool to an average cost. And if the quantities per pool increase, then you add a new layer to that. And so let's look at this. And so here was year 1, let's say, their average cost, and they're doing a whole pool, even though they have pine, oak, and maple, they're similar enough, you can put it into a pool. And they say, hey, the average cost for this pool was $247 per board foot. Now, the next year, look at this. They go from 40,000 board feet on hand to 50,000. Well, they knew that the 40,000, okay, LIFO, right? Last in, first out. Means the first ones are still there because the last ones are out. And so this 40,000 in LIFO, we assume still there. How much did it cost us? $2.47. And so that stays in ending inventory, just like it was last year. By the way, at the same amount, 98,800. Now, we look at this pool now, and we're using FIFO numbers, and we see how much on the average cost. Well, this was an average cost method. Using the average cost method, that now they have 50,000 units, and these 50,000 units in our system, they cost us $2.54. Now, if we were using the average cost method, we'd just use that as ending inventory. But we're not on the average cost method. We're under FIFO. And we know that we've added how many units? Let's just look at this. 40,000. Okay. So this 50,000, that's how much they purchased. I'm sorry, let me go back. This is where I was getting a little confused myself. They purchased 50,000, and the cost of these purchases were $2.54. Now, how many units are on hand at the end of the year? They started with 40, and they bought 50,000. That's 90 minus 46,000. So they have 44,000 units on hand. Again, that is how much? They had 40,000 board feet on hand last year. This year, they have 44,000. So this is the 44,000. So we've added a layer. The 40,000 from last year, we just used last year's cost, 247, because LIFO, last in, first out, first ones are still there. But now we've added these new 4,000, and we have a new layer at $2.54. We calculate that out, and it'd be 108,960. And so we now have our LIFO inventory. By the way, if our FIFO inventory is going to be higher than that, this is another area of rising prices, then we'd have a LIFO reserve, and we would credit that LIFO reserve account. A separate simplifying method, and this is the method I've seen in both Maytag and at Lennox, is called the dollar value LIFO. And we put a lot more dollars, inventory into inventory, and we don't have units. So we forget units. In this one, in the pooling, we got to track all the units. This one, more companies use it, but I don't have to track my units anymore. And the units could be kind of changing in sizes and whatever else. We just use the dollars. So it's a dollar value LIFO. Again, we don't get too complicated here. And we could have multiple pools. I think at Lennox, we had 2 or 3 different pools because they might have different kind of cost characteristics. We put pools like parts was in one pool, finished goods was in a different pool. And so it could be changed. And so we look at each pool as a dollar value, a quantity of value, not of units. And we calculate, okay, this goes back to maybe your economics class, like CPI, Consumer Price Index. That's what we're doing here. It's like how the CPI is calculated. We're going to go look at the cost in the new layer year divided by the cost of the base year. What's the base year? The first year we started this. And so 3-step process, we take and convert all the ending inventory dollars to the base year cost. And then we identify the layers that might be created because of at the base year cost. And then we restate each layer at the new cost index for the year inquired. And you could have multiple layers. I think at Lennox, at some points we had 17, 18, 19 layers. By the way, sometimes if you go from 18, 19 layers to only 15 layers because you liquidated, you had what's called a LIFO liquidation, you came back and got rid of some of those layers. And that would be when you, again, sold more and your inventory went down. at base year costs. So let's look at an example. I think that's much better here. So this company adopted dollar value LIFO. The inventory costs $400,000. And in 2021, the inventory value year, at year-end cost is $462. And so this is based on FIFO or whatever. However, we know that there was a 5% increase in cost. So the cost index is 1.05. Now, where could we get this from? We could do some samples, some very large samples of our inventory, and look at how much the year-over-year cost change. We could go to some indexes outside externally. I'd always question whether they really captured the right cost increases for this particular pool. So a lot of times we'll take like parts, last year's cost, this year's cost, we'll calculate this index. Here in this example, it's given to you. And so this inventory, cost us on a per unit basis 5% more. So we've got to take and convert this back to last year's cost. So we take 462 divided by 1.05. And so this 462 is really 440,000 at last year's base costs. Notice what's happened here. There's been a real increase of 40,000, not due to inflation, not due to higher costs. Real base costs the amount of inventory has increased, and that's we assume units have increased, and that now there's a new $40,000 layer that we've got to take care of compared to the base year. And this is this slide is saying the same thing here. So we got a 400,000 at base year, we got a new 40,000. Well, this 40,000, it's a new layer. So last in, first out, this 400,000 is still there, but we have a new piece that we added this year, and we'll just add this back. We'll take that 40,000. The 400,000 we keep at 1.00, same index as last year, 400,000. But this 40,000 will now go at using the new cost index. It's what we call a new pool, a new layer, not a new pool, a new layer. So we have an additional layer. We have a layer from last year. We got a new layer this year, meaning we purchased more this year than we sold this year. And so in base year dollars, there is a real increase of 40,000 that gets now translated at 42,000. So now we're at 442. And you could think each year you got to go back and everything gets equated back to the base year costs, and you see if you have a new layer or you eliminate a layer. What's the advantages of dollar value? Oh my God, so much easier, right? 3 or 4 of us sitting in the back room that know how to do it, and we have some methodology to do that. It's a monster calculation. It can take someone sitting in the room, the person doing the work, not me, 3 or 4 weeks of trying to calculate the index, trying to find all the inventory in the different pools, make sure it's complete, right? That you got everything. And so it simplifies. I guess it minimizes the probability of a liquidation. I don't, I'd have to think about that a bit before I would agree with that, because I've had layers that got liquidated, but not many times. Acquisition of new items is viewed as replacement of dollar value of the old item. So I think mainly the big advantage is it's so much easier. Let your business run on FIFO. Let your operational guys think FIFO every day, all day. Let them track inventory on a FIFO basis. And then we just come back and calculate what it would have been if we'd done LIFO. And what do? We have a FIFO inventory and debit and then a credit for a LIFO reserve. And so, and that a lot of times could be disclosed. And so, oh my God, that, dollar value LIFO, I hate to end on that note here for this chapter, because that is just crazy stuff. And now one thing I'd say, if you learn it, and you got to learn it for the CPA exam, so you got to learn it anyway, but if you learn it, oh my God, if you go in a company doing LIFO and say, hey, I'll do the LIFO calculation. Now, first of all, they're going to say, thanks for volunteering. It's yours, guarantee you. And hopefully there'll be people there to help you do it. But that would be just big kudos to you for your career if you can handle LIFO. And so with that, I'm going to end this lecture and thank you for putting up with me. I do love inventory. And next, I will be working some problems on inventory for the measurement in this chapter. And then we're having an additional inventory chapter coming up next. It's called additional issues, and they're pretty interesting. We're going to look at some other methods of estimating inventory that many retailers use. Or what if there was a fire and your warehouse burned down? How do you go calculate how much inventory is there? So I'm going to show some methods around what companies do for those situations. And with that, I just thank you for your time and best of luck.